please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
All right, four key points that have been outlined to my mind. There are a couple of other important comments also that have been made by the SEBI chairman, but four things stand out over here, and let's get reactions as well on that. Firstly, SEBI has said that they have accepted the Khan Committee recommendations on the FPI issue. That has been accepted entirely as is, and they say that they have undergone detailed consultations and they have taken in and absorbed the recommendations. The second point that they have made is with respect to the mutual fund industry. The expense ratio has been capped at 2% and trail commissions will now be followed. The other point that they have made is the extension, and this is something that had been reported by our colleague Yash Jain, that the time period for new listing has been reduced from T6 to T3. And there is a little bit of a movement as far as bond markets is concerned. Large corporates, they have identified 159. Large corporates will be required to raise 25% of their total borrowing via the bond market. So these are the critical points. There is an important point for commodity derivatives as well. SEBI has said that foreign participation framework entities with only actual exposure to trade commodity derivatives henceforth. So financial institution would help in discovery of commodity prices. Let's understand what all this means. Let's bring in our reporter Sebi Upadhyay. Sebi, let's first talk about the Khan Committee recommendations as is. They have been accepted by SEBI. No further changes. The circular is going to be out now. Remind us, what were the key recommendations that stood out, and does this seem to ease the issue and put it to rest?
In one word, the answer to that, Kritika, is going to be yes. Because most of the Khan Committee recommendations had addressed the core of the FPI, the Indian origin FPI problem. The Khan Committee was very clear that the PMLA, the Prevention of Money Laundering Act, is not to be used to decide who can or cannot manage money with respect to inflows coming into the Indian market. So yes, beneficial owners will have to be declared. We must know who is the beneficial owner of a fund, but that itself cannot determine whether an Indian origin fund manager can or cannot manage money. So largely the Khan Committee had taken the view that all kinds of KYC checks and balances should be in place. Beneficial ownership must be declared. But it had cleared the course for a lot of the NRI managers who are managing money into the Indian funds. Some of the thresholds had been outlined by the Khan Committee. Those thresholds will perhaps remain, but they were largely something that the FPI community was okay with. From the top of my head, I can remember, there were thresholds to the tune of sort of 50%. So an individual NRI fund manager not holding more than 50% in a fund. And some of those criteria were pretty palatable to the FPI community. So with this, pretty much getting the SEBI approval, it puts to rest a controversy which started on the 10th of April with that circular having issued. The grouse was that there was no consultation, but it seems that after a bit of a high-pitched drama, the FPI, the Indian FPI community has managed to find a say, and at least this is not an issue that would be a market bother. But there is another one, I'm sure the one that you've been highlighting.
Yes, so very quickly, what exactly would the impact be over here? You've been talking to people over the last couple of minutes. What's the impact on the mutual fund industry? Expense ratio being capped at 2%, trail commissions being set in. What do you make of this?
Well, okay, this is going to be a big change, and it's going to be a seminal change. It's a very, very positive step forward for the Indian investor, average people like you and me, who are investing in funds, for two reasons. One, because overall expenses will get capped. We're talking about 2.25% for equity-oriented funds, 2% for certain other categories of funds. And this is a step down from the rough ratios of about 2.5%, which is where we were. So it's a gradual reduction, and one that was perhaps always coming, something that the mutual fund fraternity was also aware of. However, what is the bigger change is the immediate move to the trail commission model. I'll quickly explain this. As of now, mutual funds were following an upfront commission model, which means that every time that you are investing 1,000 rupees in a fund, there is an upfront commission that goes to the distributor or the agent, the person who's selling that fund to you. Now, there's always a bit of an ambiguity in India between an independent advisor and a distributor of a mutual fund. So these roles end up overlapping. Now it's become very clear with SEBI's latest mandate that the entire system will have to move to a trail commission model. That means that the distributor doesn't get paid anything up front when he's selling a fund to you. he gets paid at the end of the tenure. So if you stay on in a fund for about a year or the longer you stay, basically his commissions and incentives are linked to you staying more invested for the long term in your fund. So that's a complete change from the top. And that, I mean, the very few initial discussions that I could have, this will involve a lot of sort of re-education of the entire IFA community, the distributor community. And what it will perhaps immediately mean is more market volatility because the incentive to quickly cut checks and get a lot more churn.
Okay, so we hold that thought. Very well explained. Let's get in Ashish Sumair, CEO of Motilal Oswal, who's joining in as well. Ashish, do you agree with the points that Surabhi was making? This is going to mean a lot of re-education, a lot of re-emphasis, a lot of inherent changes, but inherently cheer for the mutual fund industry in the long term.
Yeah, I'm pretty sure I agree with what Surabhi said because, you look at it this way, that the usage of commission as an influencer of which way, flows should go. I think, I'm not getting into debate of whether it was a big influencer or not a big influencer, but the point that you cannot pay upfront commissions means that even if there was any scope to influence someone by way of commissions, then I think that is out of the window. And I think in the investor interests, the AMC's interests, and the advisor or distributor's interests, everything gets aligned because, if you are in the fund and the fund is performing, then everybody gets their due fees. And if people are not in the fund, then obviously they don't earn the commission.
Very quickly, Ashish, what's the immediate impact of the expense ratio being capped at 2%? And the point that Surabhi was making was important, that there could be some, at least near-term market volatility. Would you agree to that?
So, one clarification is that from my initial reading, what I saw was that, equity funds right now, our maximum, the peak TER is 2.5. And in this, there is some slab of 0 to 500 crores, which puts it at a peak of 2.25. So equity funds, the peak TER now is 2.25. And for debt, I think what it is proposing is 2. So it's not actually capped at 2, it's capped at 2.25 for equity specifically. Debt is at 2.
Okay.
And as far as the immediate impact is concerned, look at it this way, that if, the upfront commissions, it's like this, that, the upfront commission works as, that you get an inflow and you have some incentive to get that inflow. That results in that somehow kind of results in a slightly higher volume as far as the gross inflow is concerned. So my sense is that the gross inflow would decline, and at the same time, the rotation or churn of funds, someone moving in and moving out, that also would decline. So I think on the inflows, outflows across the board, I think you will see slightly lower volumes than what you have been seeing in the past. I still have to read when is this effective from, I don't know. So that one needs to wait for the effective date.
Okay, we are completely out of time on this show, so we will have to wrap up this edition. We will take the discussion forward, as well as what it means for the commodity derivative market, what SEBI's bond meet announcements mean for the bond market as well through the day. But for now, we'll have to wrap this show. Thank you so much for watching this special coverage. Stay tuned to CNBC-TV18.